price action method with a focus on how to take advantage of the best market opportunities remaining in 2013. John will also share a special discount on the power price action method with other exclusive offers for everyone in attendance today. You're all in for a treat today to learn more about these products and methods with a veteran trader and educator. So without further ado, please join me in welcoming John Paul, founder of DayTradetoWin, for this very special Trade Like a Pro event. Go ahead and take it away, John.
All right, everyone. My name is John Paul, and good morning, everyone, on this beautiful Saturday. I'm here in beautiful sunny Florida, where it cannot get any hotter than it is right now. Morning, Marvin, Kamaljit, Wang, Richard, Ralph, everyone else. As you know, I try to bring to you with these webinars some very exciting techniques. I want you to take away from today something that you can actually use and put in place and look at the charts. Hey, Wendell, Darius. Hey, Babek. Good morning, Babek. And I also want to offer you at the end of the presentation a discount for the power price action. So at the end of the presentation, you'll be sent a link to go to a page. If you're interested, you can take a look at what the power price action course is all about. Okay? So to start off, I see here some of my students in the room. I also see some new traders. I've been trading for a very long time. I try to stay away from conventional indicators. Hey, Ali, Clay. And so the idea here is to not look at moving averages and not look at MACDs and bands and all of those things that most traders are used to looking at, but instead think about the market in a different way. Think about who controls the market. Think about the expectations, looking at the candles and the price, really understanding what you see each and every day and how to trade it. So the goal is to understand what's happening and then take an opportunity. So let me go ahead and share my chart here. And I should be sharing the chart, right? You guys should be seeing my chart at the moment, I believe, right? And what you see here is a 5-minute chart, right? Now, the idea about using a 5-minute chart, and what I want to bring to you here in the presentation, is what is the best way to understand the price. And so I bring to the attention of a lot of traders that you may not know, but if you look here at what most of the traders are looking at as far as a time scale to trade, you can see here that you have a 1 minute, a 30 minute, a 15 minute, 10, 5, 3, 60, daily. So if you take a time that can be divisible by almost all of these predetermined minutes here, you can see that a 5-minute chart is divisible by 10, by 15, by 30, by 60, by 3, 2, maybe not so much, but 1 definitely. And so the reason why I like to use a 5-minute chart is because if there's a move that's going to happen on a 10-minute or 15-minute or 60-minute, I'm ready for it by using a 5-minute chart. And sometimes traders, they want to look at all of these times put together, right? So one of the questions here is, do you use a daily chart also? And I don't. I stick to one chart instead of having multiple charts up. I only stick to the 5-minute chart. Now, if I'm scalping, I'll give you some pointers on a scalping entry that I like to use today if we have time. But for a typical day for day trading, expect a move to occur and be caught using a 5-minute chart, okay? Now, let's talk a little bit about predictions for the 2013 year. Some of you have been following me for a long time. The beginning of the year as well as last year, I introduced everyone to what I call the January effect. And some traders followed it. Some traders didn't really know what to make of it. They were just waiting and seeing. So let me change here to a daily chart and let me show you a few interesting things here that have been happening in 2013. Despite all of the bad news, financial news, everything that you hear on the TV, the market's been going up and up and up and up. So really, you really can't, in my opinion, listen to these outside influences that tell you everything is so bad or everything is so good, for that matter. You really have to take what happens trading-wise on the chart. So if you look at the year in its entirety, you see here that the year is an up year. But how would you have been able to catch this, right? So in the beginning of the year in January 2013, I started putting out, and you can actually go to my blog, DayTradetoWin blog, and you have here a situation that shows you that as the year began, the market began to move higher, right? So those of you who know this, who have been following me, this may be a little bit of review, but I think it's good to know how the year is going to wind up, whether you are long or whether you think the market is in need of a great correction, a big correction. You should know this. So here we have the market moving higher and higher and higher, and now what, right? Well, this January effect, for those of you who are new to it, takes what happened January 1st to January 31st, right here, and begins to make a formulation about whether it was a higher close than open month. And if the answer is yes, if this is a higher close than open month, then you can expect moving forward just for this year that the market will move continually higher and higher and higher and higher. But I don't just want to jump in long a little bit prematurely. I definitely want to time it correctly, because you can go long and the market can just go down and go long later on in the year. And this has been tested for as much data as we have. And this is very accurate. Every time or any time we have a higher close and open January, which we had last year, so you can take a look at 2012 as well as this year, 2013, the expectation changes, and everybody who is a hedge fund manager or a money manager looks at this January effect and expects the year to move higher and higher. Now, obviously, there is a chance that the market's not going to move lower, right? It's always an expectation that's not going to move higher. It could move lower, and that's why timing is very, very important. So as we move forward here, the market started to rally. So how do you take advantage of that? Well, the idea is to say, first and foremost, did we have a higher closing January? And the answer is yes. And then, anytime the market breaks January's high, that's the opportunity that's time to go long. Now, you don't have to go long for 20 points or 30 points, but expect a nice jump to the upside, right? So as soon as the market broke January's highs, which happens to be right away within the first couple of days of February this year, the market just went straight up. Now, I have a few ways on how to take profit and stops, right? Some of you know that I like to use proof as stops. I like to use time as stops, but most importantly, to set up your charts, and if you are going to take away anything from this webinar, is that expectations, anytime you consider a target or a stop, need to be based off of the current conditions, right? Because if you are expecting 10 points, how do you know the market's going to make 10 points? Or how do you know the market's going to make 5 points or 1 point? You would just be hoping. I hope it gets there. Instead of hope, let's take a look at this ATR here that exists, average true range, that NinjaTrader provides here. I'm using a value of 4. I'm only looking at the last 4 bars. And what you see here is that the expectations for the market moving higher are based off of the current conditions. So if you look at when the market began to break above January's highs, I see here that 17 points is exactly what I can expect out of the market. Can it go to 20? Sure. Can it go to 30? Sure. But I'm not really hoping for that. I'm hoping for the current conditions to tell me what to do. So this 17 points is my expectation. So as we move forward in time, if you're looking at this at about 1590, I could expect 1607, right? And the market went to 16 here, 07, right? Actually, let me rephrase that. At the time of the entry, it was 17 points, and it was at 1600. So 17 points from 1600 is about 1617. So this is where I expect the market to move to. So I use the ATR, the average true range of the last 4 candles, to guide me through what the current conditions are. So when I enter, and it's the candle that you enter on, you look at what has just happened to guide me to what I can expect within the next couple of bars. Okay. Now, you're right, JT here, that I'm showing you May, but it really doesn't make a difference whether it's May breaking the highs, or here is January here when it broke the high. As soon as it breaks the high, you see there 12 points. 12 points is my expectation. Then the market pulled back a little bit, broke the high. Right here, I'm going long. 17, here we go, 17 points again is what I can expect. 17 points. Pulled back a little bit, broke the high, again the same thing. Pulled back, broke the high, again same thing. This was just a much clearer example, TJ, to show you. But any time throughout January, and this is the expectation for what's to come in January, and you should definitely check out the DayTradetoWin blog, because I try to put out as much information as I can for everyone. Every time it breaks a new high for the year 2013, it's all based off of this January effect, expect a big move to the upside. The target will be based off your ATR. So here we have, again, breaking the highs. I look down, I can expect 12 points, 12 points. All right, anyone have any questions? Let me take a look here. There's a lot of questions, so let me first try to get through them. And I like to answer questions as you see them, because they're fresh in your mind. So let's take a look here. This is a great method that, believe it or not a lot of traders know about, and this is what I bring to the table: price action moves, instead of just putting up, moving average and indicators that really are always going to be behind this type of information. Okay. TJ, the ATR period is 4. I use a 4 period moving average. TJ, all right. I like to use the 4 period for the ATR in everything. Okay, so whether it be a 5-minute chart or a daily chart. All right. DM says here, do you wait for a certain criteria after a pullback to go long? The only criteria that I look for, and this is only referring to a daily chart based off of the January effect, even though I have a good understanding that the year should move higher and higher throughout the year, I'm only going to enter long, and this is as we move forward now into the future, when price breaks this current high. So this would be 1705. 1705 was the highs made here in August. Now the market can go down, but when it starts to come up, and if it starts to come up, this is going to be a pretty explosive move to the upside. And this is what I'm expecting and waiting for. And you should also look at it. If you want to wait until it occurs and then time your entry to go long after that, that's fine. But as soon as the market breaks 1705, you're going to see a move to the upside, okay? A good question here is to say, how do you determine what ATR period to use, right? Well, the ATR, if you use too large of a time frame, you're incorporating too much data. The reason why I like to use 4 as my period to enter on the current conditions is because I don't really care what happened 3 weeks ago or 3 hours ago, for that matter. I'm only concerned with the last 4 candles. Anything past the last 4 candles really shouldn't have any relevance into what I can expect. So if you look at something that happened, let's say here, this has nothing to do with what we're doing right here. So I'm only looking at the last 4 candles for me to expect what to happen within the next, also 4 to 5 bars. Anything that happened prior to that, in my opinion, has happened already. It's not relevant. All right, let's see here a couple more questions here. So you always wait for a long signal since market is going up. That's correct. So as of January 31st, my bias is long. Okay, high five. My bias is long to the market continuing higher, but only after it breaks the highs. Okay, new highs. Do you fade the first breakout attempt of 1705 and then go with the second and additional attempts? You can do that, Ed. I mean, there's so many different things that you can do. Fading it in or trailing. So there's a lot of different ways that traders approach this. My only concern is this. Where is the entry? What's my exact entry? And what can I expect out of it? I use the ATR for the expectation. And I know once it breaks it, and you don't really even have to wait until the candle closes. You can go right in once it starts breaking it by a couple of ticks. You're welcome. High five. No, Aman, always go back to the the January effect is only for January, and from that point on, every time it makes new highs, that's when you jump in. So you're not taking anything off of what happened in the closing of January. That put this in effect for the entire year. After that, I can expect the year to go up, and I can take every long trade once it breaks new highs. It's going to pull back. Once it breaks the most recent high, that's the entry, okay? Tony, 4 is the way to go, okay? It's not short. It's the last 4 days. It's the most recent data. It's actually perfect to use, Tony. Steve says here a good question is if the January 31st is lower, does it give the bias and break out to the downside? The answer is no, Steve. This is only for longs. Okay? Wow, you guys have a great amount of questions. You know, if I want to show you so much more, I don't want to spend too much time here on all these questions, but I will always answer your questions via email if you email me at support@DayTradetoWin.com. Okay? So if you guys have additional questions, also just email me. Now, if you want something that is 100%, and I think that you guys will find that there's almost nothing that's 100%, but there is something that's 100%, right? Right, the ATR is average true range, correct, right? 100%, if you want to buy something, anything that is a financial, I will show you how to do that. On every year that has ended in a 5, going back to 1800, you have 1905, all the way to 2015. Every year that has ended in a 5 has been an up year. 100%. Now, in 2015, just around the corner, I am going to be buying every financial, whether it be an option or futures, on January 1st. And if this is 100%, and it has been, you can expect the year 2015 to be an up year. So if you're looking for a large move to occur, 2015. And I invite you to go back in history, as much data as you can find. Look at 1985, 1995, 2005, and prior. It's 100% accurate. All right? All right. So let's go and move into something a little bit different here. I want to show you a little bit about manipulation and about trailing a stop as well. So I'm going to go back to a 5-minute chart. Some of you want to see a 5-minute chart here. Now, everyone knows that the markets is manipulated. Okay, I don't use stochastics, Tony. I don't use any type of conventional indicators. Really, the only thing that I use is the ATR to tell me what the current conditions are. Typically, my targets are based off the ATR, as well as any market that you look at. It doesn't have to be the E-mini, any time frame. I always look at this to guide me as far as what's to be expected. So I don't use any conventional indicators. The only indicator that I have is proprietary is the Atlas line, and that is based off of price. It's not based off of any moving averages or anything like that. So I have here a 5-minute chart, and what you're going to notice from this 5-minute chart is that the market comes up and stops here, and then comes up and starts to move again, right, and stops here. Now, I'm not saying that I know exactly where the stop is going to be. There are ways to know that, but you have to take into consideration that if you look at this and you have a moving average and you have your MACDs and all this other great stuff, and you may have 10-minute, 15-minute, 30-minute, out, whatever. As soon as the market hit 1661, something happened, right? Something happened that will change this to go short. Now, prior to the big fall, we have to take and think about what's going on, right? What's happening here? So let's talk a little bit about the normal trader. Normal trader looks at this and has a couple of moving averages. Some of you may be using this or another indicator, and it's all telling you to go long, right? There's no reason why you should think about short. But there's a missing link here. The missing link is as soon as the market hit 1661, there was an overwhelmingly power of shorts that overrode all these longs, the little guy like you and I. Why does that happen? Because there's nothing here foretelling it, right? Market opened and it just went right to the downside. So how does manipulation work? Well, first we have to see and understand what these traders are doing, these big traders. Now, I don't trade 100 lots or 200 lots. Typically, my average is between 10 and 20. That's what I'm very comfortable with. Sometimes up to 30, but the fills get very hard at that, when you start going above 20. But if you had an opportunity to trade, let's say, 2,000 contracts, would you, as a trader, put all 2,000 contracts here to go long? Or here? Or here? What do you think? There's no volume here, Kumar. I'm not looking at any type of volume. Okay? So, if you had an opportunity, would you go in with the huge amount of contracts? And the answer is probably not. right? ATR is too low, right? But forget about the ATR here for a moment. Forget about what you think of volume and all that good stuff. If you had an opportunity to put all of these contracts on, it would be unwise to throw it all in one shot. Spread them out, right, Vaughn? So the way that many of the funds and the bots and all of these bigger players that are in the market, they start going in 10, 10, 20, 50, 50, 50, 20, 10, right? As this market is moving higher and higher and higher. They just buying, buying, buying in small increments. Now, I don't look at market profile. I don't look at Fibonacci's. Those of you are in the room that are my students, you know that I don't use any of this stuff, right? That's conventional. But I do know that as this market is going up, there's an accumulation occurring. I've seen it happen, so I know exactly how this works. It comes to a certain point where it's time to take profit. You've accumulated 2,000, 5,000, 10,000 contracts. It's time to get out of the trade with some profit, right? How do you think, right? The bigger question now is, how do you think that the big traders get out of their position? Do they get out and scale out in the same way? Or do they instead get out faster? What do you think? You want to have any an idea? Right, Norman. They get out with a little bit more of a anticipation because now, that's right, Darius, they want to dump them. Right, Dwayne. Very good. So the idea here is to see that there's a trend, but expect that at some point in time they're going to say, get me out. And when they get me out, when they say get me out, it may not be getting out at 50s and 100s, or maybe 200, 300, more of an accelerated pace. And that is the manipulation that I refer to and what I teach my students, because when you have this going straight up, there is really no reason to think the market's going to sell off. But it does. And the only reason why that occurs is because there's overwhelmingly a huge amount of sellers that are now taking profit, absorbing everybody that's long, and that is the reason why you see what you see. You will never know this is going to happen, right? There's no indication that this is going to happen. This is actually yesterday. And it happens all of the time. And that's the reason why you can look at, if the market's moving in a trend, you can put on any moving average cross and it'll tell you, yeah, it's great, let's go long. But you never know when that's going to end. And it will end, or at least pause, or at least pull back when the big players step in, okay? No, Allah. Great question. Allah says here, shouldn't these big traders be worried that some bigger trader than them reverses the market early? That's a very good question. I have to say, they don't work against each other, Allah. They work with each other. So it's more of an old boys game where everyone knows where to get in and get out. They're not really fighting one another, okay? It doesn't work that way. Okay. Now, there's something called, and this is my term, I'm sure that there's other names for it, yo-yo bars. And this is something that I teach in the Power Price Action course, where what you're looking at is an indication that the market is going higher and higher and higher, or lower and lower and lower, and it's starting to encounter difficulty. Okay? Now, if you look at what a yo-yo bar is, think about a kid's toy. The yo-yo goes down, and then it gets swung straight back up, and what you're left with is a wick. So it did like a yo-yo, right? Or the market goes up, and it can't contain itself because sellers come in and the market goes down. Well, you see these yo-yo bars everywhere, right? Candles with wicks. It's not anything a big secret, right? Here, you see here that, you see that here, you see that there, here, you see here, 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 right? So I'm just showing you candles with wicks, right? No big deal. But the idea, look at this guy right here. The idea is not to look at just one candle. The idea is to have the proof where you see not just one, but multiple bars, these yo-yo bars, telling you that something internally is changing. Okay? Something internally is changing because it's trying to move lower in a trend, trying to move higher in a trend, and it's failing. So you take a look at that, you say this by itself means nothing. But if you look at the candle prior to it, it's trying to go lower. This doji went a little bit lower. This doji, or this red bar, went a little bit lower. Then it has a yo-yo, right? Then you have it again trying to go lower. Then you have it again trying to go lower. So think about this in perspective here. We are in a downtrend, no doubt about it, right? Market comes to a certain place, it can't continue on this downtrend. Well, what are these signs, what are the indications that are telling you that? Now, I don't do any candlestick interpretation, Frenchie, hammers, shooting stars, things like that. I don't teach that. I think it's great to know, but I don't teach it. I instead prefer to look at these wicks, candles with wicks, and a grouping of them to lead me to believe that this trend to the downside is in trouble. And if it's in trouble, right, then why am I going to continue to go short until it breaks that, right? I'm not. I'm going to look for long opportunities, all right? So when I see a grouping of these yo-yo bars, to me, the writing is on the wall. Something internally is beginning to change. Another example. This is an uptrend. It's trying to go higher. And I see these yo-yo bars. Comes up, comes down, comes up, comes down, comes up, comes down. Trying again, trying again, trying again. It becomes very clear. And one of the things that I use is that the market here is very difficult to understand if you expand it. Okay? But if you crunch up your chart, you're going to see that it becomes very clear that after a trend has been identified, you can see these groupings, right? I see them here, I see them here, I see them here, right? It doesn't have to be head and shoulders or any of those typical patterns. I'm just looking for a grouping of yo-yo bars that tell me that the trend that we're on is in trouble, okay? Now, it doesn't automatically mean that the market's going to reverse, and most of the time you can say that it does. But I want to keep the options open. So from that point on, it may be just a pause in the market where it may continue higher or may continue lower within that trend. But for right now, I'm not going long or not going short based on what is happening. Right? The same thing with this here. Right? So a grouping of these yo-yo bars together, okay? Should be a light bulb that turns on. Okay. Now the way that I like to set up my chart is I like to have, and I'm a dome, not that you can't use the chart trader, but I'm a dome guy. Where's my, here. So here I have my dome, and this is the way that I like to, just make sure I'm in sim, okay? This is the way I like to have my dome on the right because it's as close as you can. It's as close as you can to the most recent chart instead of putting chart markers instead of putting it like this, where you're looking at the most recent price and the DOM is here. I like to do it like so. Now, one of the things about NinjaTrader, and I like NinjaTrader as far as a trading platform, the data, kinetic, I think it's one of the best platforms that are out there. And the guys at NinjaTrader do an excellent, excellent job. With the DOM, you have this, if you want to go short on a limit or long on a limit, you have this box that comes up here. It says, do you want to place this order? And there's a way to turn this off, right? When you see this here, this is an opportunity for you to get a good price, but to wait. Now, I use this and I teach this when it comes to scalping. In scalping, typically it's a point or less, right? And the market moves very quickly. So if you're looking to scalp the markets, one of the ways that I like to use the DOM to my advantage, right? The market's going up, the market's going down, market's going up, going down, and you want a price. Let's say you want 1660, right? Or you want 1660.50. The way that I use the DOM is that I'm not going to place a stop or stop with limit, because I may want to wait for some type of proof, a closing below, for example, below 1660. So what I do is I place here a limit order, and I leave this box up without clicking yes, and the market's still moving up and down, up and down. So it's almost like it's a pending limbo order. And as soon as I see, just as an example, the price close below 1660, and a lot of what I do is based off of closing candles. So I'm not looking to go in. Some of the methods I teach, they go in intrabar, but most of the time I'm looking for closing candles. The candle closes, and then I go in. So if I know the exact price that I want to enter, let's say it's 1660 to go short, and I need to see a closing candle below 1660 before I click yes, I have this box up waiting with a limit order to go short at 1660. Actually, it would be, let's say, like that. And as soon as I have the proof or indication I want this price, I can then go ahead and click yes. This way, it spares me the time to go to my DOM, look for the price, click on the sell, click yes. All this takes time. And I use the ATM strategy all the time. Almost daily, I always have, and this is me teaching my traders, how this works with, showing them how this works. After you create one, you can do manage ATM strategy template, right? Save it, something. So I have all these, but you really only need 3 or 4. You don't need all of these. This is me teaching my traders here how this works. So use the DOM to your advantage by knowing the exact price that you want to get in, clicking on the price, but not entering until there's proof. Okay. Let's see some questions here. It could be a pause, right, Steve, before the market changes or continues further down. How do you find the yo-yo in between the trend? Danish has a good question. I'll show you how to identify a trend first, Danish, because if we're going to look for these yo-yo bars after a trend, we should look for them. We should know how to identify a trend first, right? Ben says here, I thought you do not use or look at the DOM. Ben, use the DOM all the time. This is the price ladder, the DOM. If you've seen the hundreds of videos that I have, you see the DOM there all the time. Right, sell stop. It's not really a sell stop, it's a sell limit, Lance. Here, not looking for so much momentum, but for proof, Norman. High five. How do you get this window to show? Every time you place an order, you should have, this is defaulted on NinjaTrader. Do you want to place this order? And you have to click yes or no. It's in the I believe it's in Tools and Options of your Control Center. And actually, it's right here. I'll show you right here. Confirm order placement. If you have this box checked, you're going to get, high five, are you sure you want to place this order? Some traders turn this off, and as soon as you click limit, you're in. I recommend having this on, okay? The other thing that you should do once in a while, I'm not sure if those of you who are using NinjaTrader know about this, but I clear out my data with reset and repair at least once a month or every 2 months or so. I find that sometimes the cache slows down my computer, so I reset and repair data a few times out of the year just to make sure that my NinjaTrader is running optimally. It's something that sometimes goes overlooked. Okay, so it's in confirm order placement. Okay. All right, GB. Russell has a question here. If I'm using a 5-minute bar timer and the current candle is, say, 6 ticks in the direction of it closing in my anticipated favor, couldn't I safely front run the trade by a couple of seconds to get a tick or two better? Yeah, you could, Russell. Front running is getting a better price than everything else, than everyone else, I should say. You could front run it, but remember, everything that I use proof. So it has to close below a certain value, above a certain value, and once I realize that there's proof to go long or short, I just don't want to go in at market. I want to use a limit order. I don't want to have any slippage, and that's when I use this idea of I want this exact value, but let me wait until there's proof before I go long or short. That's one of the ways that I like to get in on an exact price. Okay, let's talk a little bit about, I know you guys have a lot of questions and I don't want my time to run out here. Let's take a look at, and remember, email me. You have any questions? Email me. What I want you to take away from this webinar is an average true range of 4 dictates everything I do. If the market is less than a point, typically I look at a 5-minute chart. Anything less than a point, I believe that it's not worth trading. And if you look at the relationship between what's happening here and here, you see that whenever you have the ATR dropping below 4 ticks, and I would say across the board, any market, you typically have a doldrum, nothing happens, and it's not worth trading. And I teach this to my traders. I say, whenever you see the ATR fall below 1 point, it's not worth it. It's not worth getting in. You're just going to get dojis and gaps and whipsawed. Okay, so also only look for opportunities when the average true range is above a point. You have the best chance to make the move. Okay. All right. Well, there was a question earlier which I think is important to bring up here, which says, it was something along the lines where a trend, how do I know there's a trend? What do I do in between trends? So how do you guys identify a trend? How do most of you here look at the market and say, for certain, I know there's a trend, or I don't know there's a trend? How do you guys do it? You guys want to share with us? Because I have a very specific way, which is objective, which leads everyone to be on the same page. So you can't say it looks like or it could be, right? By sight, some of you say crossing moving averages. Okay. EMA 50, okay. How about we use price instead? How about the 6-6 rule? Anyone ever hear about that? Again, this is something I teach. In order to identify a trend, you have to have a combination of not just distance, but also not just distance in points, but also number of candles. So I'll give you an example. When you have a news event, and the news brings one bar to be 10 points, right? So you have a one candle that is 10 points. Would you consider that one candle a trend? No, definitely not, right? It's just one large range bar. It's not a trend. Well, what about when you have 100 candles that are whipsawing, channeling back and forth, let's say 2, maybe 3 points, up and down, up and down? Would you consider that a trend? Right? All they're doing is channeling like this. Let's say if you look at something like that. Would you consider that a trend? I would just definitely say no. Now comes the combination of the two, right? You stop with the exponential moving averages and those indicators. I'm telling you guys, the regular indicators are lagging. They don't work. Okay, you have to look at price. 6.6 here tells me that if 6 points of distance and 6 bars have traded, you have a trend, period, right? I don't use any type of support and resistance or pivot points or value areas, Gonzalo. I don't. What I teach is manipulation and how to understand price. So 6.6, 6 points, 6 bars. So what does that mean? It means that if I take this here and I say to myself, has the market moved 6 bars or more, and have we gone 6 points or more, I have a trend. Period. 6.6, 6 bars, 6 points. The same thing here. The market starts to move up. Once it has moved 6 points up, 6 candles or more have plotted, we're all on the same page. I've identified a trend. Six points, Vaughn. 6 points, 6 times 4 is 24 ticks. 24 ticks in the E-mini, about 30 ticks in the currencies, because the currencies are a little bit more, work a little bit more. What's important to note is that you have to have a combination of 6 or more candles plotting, and you also have to have distance. You can't be just one or the other. So if you ever are not quite sure, or maybe some of you have your super duper moving averages on there and you want to just validate, use price. Say, has it moved 6 bars? Has it moved 6 points in distance? The combination of the two equals we're in a trend. You can look at it that way, Kale. Sure, you can. Right? And the reason is because if we look at the market, right, how do I know that this is a trend to the upside? Or how do you don't know. You're thinking and guessing. From this point right here, if this goes down 6 bars, 6 points, everyone think, oh, I've identified a trend, right? Pips, Lori, I would say if you're looking at FX, think about 30 to 35 because you're looking at currencies, right? They work in ticks and pips. So 30 pips, ticks, a distance of 30 would tell me the same thing. But you have to combine it with the number of bars because one bar by itself is relevant, right? You need to have a little bit of data to say, here we are, we're going, and it's a routine matter, okay? I like 5-minute charts. I teach everything in a 5-minute chart, except when it comes to scalping. I like 1 minute, and I like a tick chart for scalping. And the mentorship goes into all of this information, is all included in the mentorship. Okay? Right, 24 ticks on the ES, exactly. Okay? Yeah, so the question here is, can you explain about 6 bars for ES? So, for example, here I have, just an example, 1, 2, 3, 4, 5, 6. All right. So we have 6 bars here. Has the market moved from this high down 6 points? And the answer is no, right? But if you wait until it has moved 6 points, right, 6 points, and you have maybe 10 bars, 20 bars, 30 bars, but it's moved that distance, you can now say, based on this data, right, you can say it's moved 6 points and it has at least 6 candles plotting to make up the 6 points, right? 6 points is 24 ticks. For those of you who are not familiar with points, the E-mini works in 4 ticks equals a point, and so when I refer to points, it's 24 ticks. So it would be 24 ticks on the E-mini, about 30 ticks on currencies. Just to be clear on that. You know, the other question I get a lot is when it comes to currencies here, how do you determine the ATR, right? I get that question all the time. In case some of you, I see there are currency traders, you want to look at these values here, move the decimal place over 4 places to the right, and therefore what you're seeing is 0.000333. How do you interpret that? Well, 0.000333, if you move the decimal place over 4 places to the right, 1, 2, 3, 4, what you get is 3.33, which is equal to 3 pips, 3 ticks. So this is what the current conditions are on the most recent candle here. Again, the market's too slow. My recommendation is not to trade unless it's 4 ticks or more. So this would not, for me, even be an option to jump in here. How do I identify a trend? I want to make sure that we have 6 bars at least plotting and say 30 ticks. Same thing, 6 bars or 30 ticks. Okay? What if the 5-minute trend counters the hourly trend? I'm not looking at the hourly trend, Vaughn. You think about, how much data is in an hour, right? I'm not concerned about what's happening in an hour. All I'm concerned about is if I have a 5-minute chart, I have 6 bars or more, I can identify a trend pretty easily and without any nonsense of indicators to tell me I've identified a trend, okay? It's the best way that I've used to understand what the bigger picture is. All right, but definitely email me. You guys have questions? I'll be happy to send you my my comments if you email me at support@daytradetowin.com. All right, so we covered a prediction for 2013. I want to make sure you guys know that there's longs. The dome, I always like to have the dome on my right. I have the ATR 4. I identify a trend using the 6-6 method. Trailing stops I wanted to talk about. I also want to talk about trading the news. I spoke about manipulation. I spoke about yo-yo bars. Have you guys seen my video on trading the news? It's a free video. You can get it for free by visiting DayTradetoWin.com and putting in your email address to get 3 free videos. I'm going to give you something that will open your eyes a little bit for those of you who don't know, right? How to trade the news. Take a look at yesterday, and by the way, there's a huge variety of ways that you can check for news events. For example, I use and I like the Bloomberg here, right? It tells me that on Friday there was home sales here at 10 o'clock. So I know that I have to be careful. I also have here, if you go to software, and I have a lot of free stuff that's available, free downloads. You have here a news indicator for NinjaTrader 7. It's an actual indicator that plots on your NinjaTrader charts. So you see here, right on your chart, up to the minute, it refreshes. Every minute, you're going to have an indicator that tells you to look out for a high priority. You can actually make this whatever you want. You can have it only for European, for the currency traders. You can have it for the US. You can have it high priority, low priority. There's a lot of different settings there. But you have an indicator that plots directly on your chart. And a lot of traders email me, say this is great because they always forget, but this is always staring you in the face. So you can go to DayTradetoWin and get this news indicator. Okay, and there's also a calendar that I provide for free, online news calendar, right? That's what it looks like here. Right? All right. So let's get back to the Bloomberg so I can show you that there's a news event yesterday at 10 o'clock. How do you trade that? Right? Well, let me show you. Yesterday at 10 o'clock was a news event for new home sales. This guy right here. Again, GB, the 3 videos, if you just go to DayTradetoWin.com, there's on top, there's a little email box that says place your email here to get these 3 free videos. So you get the 3 videos there. Or on the videos page, right? You can go to videos page of DayTradetoWin. There's hundreds and hundreds of videos of me trading live, of my education, right? You got a lot of free stuff there. Okay. So if you take a look at this, the market's going down and down and down, and the news comes out right here, right? Okay. So now what? Well, the first thing that I teach most traders to do is not to trade this news. Stay out. Instead, let's look for a better opportunity to trade this news if and when it happens. So here is how it works. If I see a candle that's a reaction, it has to be a candle that's reactionary. This method does not work unless it's reactionary. There has to be a reaction to the news. So new home sales, up, down, I don't care. I don't care what the value is. I just want to know, did traders jump in like a herd of cattle based off of this number? Did they all buy or did they all sell because there was a good number or bad number? And so how do I know that? Well, look at this candle, compare it to the last 2 or 3 bars, and it's much larger. So I know that there was some reaction to the news. I then say to myself, well, let me just put these rules here so you guys don't forget. Let's say that there's reaction to the news. Positive or negative, it doesn't matter. Then I say to myself, was the candle red or green? I don't want to make this overly complicated because really a lower close than open, higher close than open means a red or green candle. Now, if you think about all of the traders, right? If everyone here in this room went short, okay, hypothetically speaking, let's say everyone went short, and as soon as you go short, the market doesn't go lower. It starts to kind of, flip-flop, and it starts to go up. Everyone in this room would probably do the same exact thing. And I'm not saying that. I'm saying this because I'm just saying that this is the only option we have. We're going to get stopped out because we all went short based off of this news. I'll include myself in this, right? Market goes down, right? You're probably going short around here somewhere. The market's starting to go up. What is your option? Your option is to get stopped out or to reverse. And what happens is a reaction in the opposite direction where everyone just jumps on board the long side. First they jump ship to the short and then they change their direction. And what I look for, see, I'm not trading this at all. I'm not looking to go short here. I'm only looking to do the opposite. I want to enter opposite the reaction candle. So if everyone went short and the market does not go and follow through, everyone has to get stopped out. They have to cover these short positions and maybe hit reverse. And there's a fuel. It fires the market in the opposite direction long. Where do I go long? I go long after 2 consecutive closes. In this case, because the reaction bar is red, 2 consecutive closes above the high of that candle, which everyone went short on. So I am going long after I recognize 2 candles have plotted. Okay? So at this point, I go long. Market went up. So based off of what you see here, I want you to think that, and sometimes it does happen where the news is negative, everyone goes short, and the market goes down. Fantastic. I'm happy for the traders that made out. But I'm not quite certain that there's a direct relationship between the market having negative news and the market going down all the time, and vice versa. Positive news and the market going up. I instead want to wait, and I want to be very conservative, and I want to say to myself, did the market do what everyone expected? And if not, these traders are going to have to reverse, and it fuels it opposite, and that's where I jump in. I jump in after the reaction occurs. Okay? So I definitely invite you to take a look at those videos that I have on the videos page, where there's 3 videos. You can go to the videos page, you can opt in, you get my newsletter where I talk about a lot of these things and expectations. I think it will definitely benefit you. Look at the ATR as far as a target, right? If you look at the ATR is about 2 points, 8 ticks. I can expect at least 8 ticks out of this trade, right? So always have expectations. Rick, on FOMC days, this is what I can expect on FOMC days. Chop. Because, and again, this is psychological, and not that I go too much into psychology, but think about everyone who's trading knows it's FOMC day. Are you going to place a trade heavy to the long side or heavy to the short side, knowing that in the afternoon there's going to be a whipsaw? Or I should say, there's going to be some type of news release happening in the afternoon? Chances are that whenever you have an FOMC day, and you can go back in history, the day is typically whipsaw. And as soon as that FOMC comes out, the same thing happens, right? So the latest FOMC day that we had, we can still use trade the news, right? Nothing changes. So let me take a look here. It was on the 21st. Let's take a look at the 21st. FOMC day, right here. So what do we have prior to this FOMC release? You have market goes up, market goes down, it's chop. Nobody is committed to taking a long or short trade for the day. Based on what I just showed you on how to trade the news, I think this is for, I forgot who asked here the question, Elias. Elias or Seth, Ben? Take a look here at the high. If you go short here, you're thinking, man, this market's going to rock. It's going to go straight down, right? Well, it didn't, did it? You know what happens here? One, two. I'm long. The ATR is 3 points. Wow, 3 points is pretty big. But guess what? 1650 to 1650, 350. You could not get more accurate as far as a target than that. And what did I use? I didn't use any EMA here. I used the average true range to tell me what my expectation was. My entry, second consecutive closing. I know exactly what to expect. This here, everybody went short. It went, at one point, this whole candle was down. Do you know what kind of candle this is? What I referred to earlier? You guys remember what this yo-yo bar? Now, I don't know about you, but at one point this entire candle was red. And this would have, if you would have seen this live, you would have said, wow, this market, that's it. This is the drop everyone's talking about, right? Market's going to just tank. And some magical force, right? Let's just call it magical force, was able to overstep all of these sellers and manipulate it, I have to say it, guys, all the way back up. Therefore, everybody who was short got stuck. As soon as it starts to break this high, this is where everyone has their stops. It's normal. Everyone has their stops, and then they may even hit reverse, and it fuels the market in the opposite direction. I'm not doing anything. You know what I'm doing? I'm waiting for this. If it happens, I'm waiting for that to go long. I know what my profit target is, and that's that. I use that, Tony, magical, not because it's not magical. It's because it's, unfortunately, it's manipulation that the bigger traders, they can go in with hundreds. We can't do that. And I've seen it happen plenty of times. And I'm just kidding when I say magical. It's not magic. It's manipulation, right? The Atlas line, Yahi, does not work on daily bars. It's only for day trading. Okay. It's only for day trading on a 5-minute or 15-minute. Okay. That's right. I'm sorry if I can't say your name correctly. Srinith G. It's because they're covering their short positions, right? So if you're short and the market goes up, you have a stop, you get stopped out, so there's buying. And then you hit reverse, there's more buying. And this is what you're seeing, everyone panicking. So Abby, for example, good question. Abby says the ATR, right? Do you want to show the entry? So if you see that I'm waiting for 1, 2 consecutive closes, would you say, this is for Abby here, had a question, that on the close of this candle we're going long based on what I just showed you? Okay. I immediately look down because every candle is now recalculated this average true range. So if you look straight down, you look at this number. This number is 3.8, right? So 3.8 is points, right? You have to, if you want to know ticks, you multiply it by 4. So it's 3 3/4 of a point. So I know if I enter long, at the close of this candle, this is my expectation. Okay, Abby? So I want to make sure you're clear on that first. Okay. Now, the next candle. This ATR is 3.66. So you round down quarter point increments, E-mini quarter point increments, so it works in 25, 50, 75, 100. So 3.5 is what I can expect, right? But I'm still long, right? Now I have here 3.43. So I can expect 3.25 or 3 1/4 points, which is 13 ticks, right? Now I can expect 12 ticks. I'm sorry, 3 times 4, 12. So you're adjusting your profit target based on the most current conditions that the market shows you that it's doing. So if you look at this here at 1650 quarter as the entry, and you add 3 points to that, it would be 1653 quarter right here. If you add 3 3/4 of a point, the initial target, right? You still made that. That is 1654. So this told you that you can expect moving forward the market to move 3 3/4 of a point. but I still adjust in case the market be starting to whipsaw back and forth, right? So Abby, I want to make sure that I answered your question correctly. Okay, good. You're welcome. For the ATR average true range, you can see it right here. It's setting a 4 right there. Okay. Excellent. Now, I'm sure that I missed some of your questions. This is the E-mini S&P, the ES S&P 500. But again, please email me if you have any questions, or watch the videos on the videos page. The videos are definitely eye-opening. The educational videos there, I offer them for free. Feel free to check them out. All right. Now, before I end here, there's a couple of things that I want to say. First, I want to thank NinjaTrader, and I want to thank you guys for coming here on a Saturday to hopefully take something positive out of what I have to teach. I am offering a special discount. This is just for the traders here who joined us in the room, the NinjaTrader. There's a $300 off special, good through August 31st. You're going to get an email from NinjaTrader and from me to access the page with the special offer. It's a DVD course, the Power Price Action. It's typically $1,000, but now it's $300 off as a special. There's a few bonuses that are included. It's what's called the Floor Trader Secrets Manual. It's a separate course that I include with this based on manipulation. I have included some new software which I just got coded, which I'm going to include. Okay. If you have any questions on this, please tell me, but this special offer is for the Power Price Action DVD course. And the page, I know you're going to get the link via NinjaTrader, but the page is DayTradetoWin.com/PPA. It has here the special page to access this, what you see here, okay? Does not include the Atlas line, Dion. Norm, I think you get maybe 3,000 free trades with that, not 1,000. But I'll check with that. See if I can bump you up to 3,000. All right, guys. Again, I want to thank NinjaTrader, Ray, and Ryan. I'm going to hand it over to them. They're going to send an email to access this page. I want everyone to have a great rest of your weekend, and hopefully I'll talk to you soon. The training for the Power Price Action is every Wednesday at 11 o'clock. So for 8 weeks, you're with me with the Power Price Action training. So not only do you get the DVD course, but you also get the training that goes into what you see right now. It's an hour training, typically an hour training every week for 8 weeks. All right, you got it, guys. I believe the replay will be either on the NinjaTrader site or on the DayTradetoWin site. Okay, you can review this. And you can email me if you have any questions, guys.